Hello and welcome to another Dividend Dynamos video. Today we're diving into one of the most sought-after topics in investing, which is generating passive income through dividends. Specifically, we'll outline a simple yet effective strategy to earn $500 per month in dividend income. Before we start, if you're new here, please take a moment to like and subscribe to the channel. I'd really appreciate it, and it'll help grow the channel to reach more investors like you. The content in this video is provided for informational and entertainment purposes only. It is not intended as financial advice. I am not a certified financial advisor, and any financial decisions should be made based on your own research and consultation with a professional financial advisor. Now let's get started. The first step in our strategy is selecting high dividend yielding stocks from strong, solid companies. These are companies that consistently pay out a significant portion of their earnings to shareholders in the form of dividends. But beware, not all high-yielding stocks are created equal, I caution you. Don't chase yield. Instead, look at the stock's total return, which factors in stock appreciation, reinvested dividends, and the expense ratio. It's essential to research and choose companies with a history of stable dividend payments and sustainable business models. Look for established companies in sectors like utilities, telecommunications, and consumer staples, known for their reliable dividends. Look for dividend aristocrats, companies that have paid a dividend for 25 or more consecutive years, or dividend kings, companies that have paid a dividend for 50 or more years consecutively. You can find these with a simple Google search. Next, diversifying your portfolio across different sectors and industries is crucial for managing risk. By spreading out your investments, you can minimize the impact of downturns in any single sector. Aim for a well-balanced portfolio of dividend-paying stocks to capture diverse income streams. Consider allocating funds to sectors like consumer staples, healthcare, and energy to further diversify your income sources. Now let's talk about dividend-focused exchange-traded funds, or ETFs. These funds track indexes comprised of dividend-paying stocks, offering instant diversification and convenience. Look at ETFs as a basket of stocks all in one package. Seek out ETFs with low expense ratios and consistent dividend yields. Investing in dividend-focused ETFs can provide exposure to a broad range of dividend-paying companies, reducing the risk associated with individual stock selection. Plus, they're an excellent option for investors seeking passive income without the hassle of managing individual stocks. Dividend-paying ETFs to consider could be SCHD from Charles Schwab, which pays a dividend of 3.42% and has an expense ratio of just 0.06%. VYM from Vanguard is another good choice. It pays a dividend yield of 2.89% and also has an expense ratio of 0.06%. Both of these ETFs pay dividends quarterly. Both VYM and SCHD are passively managed, which helps keep the expense ratio down. Monthly payers might include JEPI from JP Morgan. JEPI has a dividend yield of 7.52%. Its expense ratio is 0.35%, and year-to-date it's up 5.44%. Another monthly payer is JEPQ, also from JP Morgan. JEPQ sports a dividend yield of 10.87%. The expense ratio is also 0.35%, and year-to-date, JEPQ is up almost 10%. DIVO from Amplify ETFs is another popular monthly payer. This one is actively managed, so it has a higher expense ratio of 0.56%. The dividend yield is 4.55%, and so far this year the fund is up a little over 5%. The expense ratio is something you'll want to pay close attention to when picking ETFs. And remember, the more shares you own, the more passive income you'll receive. Invest regularly and watch your dividends grow. Do your own research and pick the right dividend-paying ETF for you. Also, reinvest your dividends. One of the most powerful aspects of dividend investing is the compounding effect. By reinvesting dividends back into the same stocks or ETFs, you can accelerate wealth accumulation over time. This means that your dividends generate additional dividends, which are then reinvested to generate even more income, a snowball effect. Take advantage of dividend reinvestment plans, DRIPs, or your brokerage's automatic reinvestment feature to harness the full potential of compounding. You'll want to monitor and adjust your portfolio regularly. Regular monitoring and adjustments are essential for maintaining a successful dividend income strategy. Keep a close eye on your investments, monitoring dividend payouts, company fundamentals, and market trends. Periodically review your portfolio's performance and make adjustments as necessary to stay aligned with your income goals and risk tolerance. Remember, investing is a dynamic process, and staying informed and proactive is key to long-term success. And there you have it, folks. The easiest 500-month dividend income strategy broken down into 5 simple steps. By selecting high dividend yielding stocks, diversifying your portfolio, considering dividend-focused ETFs, reinvesting dividends, and regularly monitoring and adjusting, you can build a steady stream of passive income to support your financial goals. Be sure to hit that like button, subscribe, and leave a comment below. Thank you for watching and happy investing. Always remember to keep your feet on the ground and keep reaching for the stars.